Hi there, welcome to Kneppy's Portfolio. This will be update number 19 to this video series. It's been 2 weeks since I did the most previous update, and it's fair to say the market's looking fairly bullish in those 2 weeks, up towards 7,000, the XJO, and my portfolio, this Kneppy's portfolio, has performed exceedingly well. So very happy with the performance of this investing philosophy or strategy. So those who are new to this video series, what I did in August of 2020 is I started a new portfolio which took into account or started to follow a new investing strategy that I was looking into, because when I started investing, I used sort of the value approach, looking at buy and hold, buying companies which I thought had a really good future, say 10 years down the road. And sometimes the share price of those companies was flat and didn't do anything for years and years and years. And my whole thinking around how to invest has evolved over time. And I believe taking into account psychology, human psychology, momentum and sentiment is a very good way to supercharge your returns. So I wanted to test that theory. So I set up this portfolio and I started to track this portfolio's performance compared to the benchmark. And at this moment, it is exceeding my expectations, well exceeding the benchmark performance. And the whole reason I wanted to exceed the benchmark performance is because if I can't beat the market, I might as well just put my money into an ETF. And my ultimate goal is to double the market returns. And the main reason I want to double the market returns is because I'm a huge fan of Peter Lynch and Warren Buffett. Peter Lynch, his fund, Magellan Fund, between 1977 and 1990 had annualized returns of 29% per year. So he doubled the market. He retired in 1990 at age 46, and he is considered one of the best investors of all time. Warren Buffett shouldn't need any introduction, but Berkshire Hathaway between 1965 and 2020 had returns on an annual basis of 20% per year. Again, double the market returns. So it can be done. There's a lot of talk out there that you cannot beat the market returns, so you should just put your money into ETFs. That's a fallacy. In fact, read Peter Lynch's book, One Up on Wall Street, and he actually says in that anyone can beat the market. And that is my thinking. I can beat the market, and I'm trying to find ways to do that, the best ways to do that. So I developed up this strategy, and I'll get into the next slide what that strategy is. And I just wanted to see if this strategy could beat the market, because over the years, when I've ever used this strategy, on the rare occasion, it did really well. So that's why I decided to set up this portfolio and track it to the benchmark. And at this point in time, it's doing very well. And you'll see that in the next few slides. Now, my buy and sell strategy in regards to this portfolio is fairly simple. And what I'm looking for in particular for buys is breakouts in the share price that correspond typically to very positive announcements. And that's the main thing I'm really looking for, are those positive announcements. And typically, not always, but typically those positive announcements are profits or earnings upgrades. There is I've heard this a lot, that you buy on the rumor and sell on the news. But when it comes to these positive sort of announcements, profit upgrades, you don't do that. You do the complete opposite. That's when you buy, because the market loves those sort of news flows. And the most powerful sort of move in the share price of a company is when you get that really positive news, a profit upgrade, or some sort of wording that management uses in a half-yearly or yearly report, and that corresponds to a shift in sentiment or momentum in the share price. And you can see that a lot. I have quite a few examples of that. Pact Group was a really good example recently. I won't show you Pact Group in this video, but have a look at their share price. You can see where their share price broke out on their half-yearly on really big volumes. So it was the most obvious buy I've seen for quite a while. Now, when it comes to the sell, it's the complete opposite. Whenever you see any sort of negative news, profit downgrades, that's an automatic sell, or a shift in momentum and sentiment in the company's share price. Now, I've gone a slight away from these strategies in the past few weeks. I sold out of BlueScope Steel, even though they didn't have any shift in momentum sentiment or any negative news, simply because the share price had risen 55% over 6 months. And my thinking at the time, I could redeploy that capital to other ideas, simply because an increase in share price of 55% for BlueScope Steel was quite significant. And over the past week, I did buy into a company, CleanSpace, when they didn't have a breakout in share price or a shift in momentum and sentiment. In fact, their sentiment is at almost all-time low. But I believe, or I do think, that the share price doesn't have much room to fall from here. I could be wrong, of course, but I believe this is the complete opposite, buying when the market has completely overreacted to a bit of news. The first thing I usually look at in these videos is to see what's happening in the overall market. And I do like to see this because you do get a bit of a gauge of the sentiment in the stock market when you look at the charts. So this is focusing on the XJO, which is the ASX 200. This is a 6-month chart, daily chart. And the first thing you'll notice is we've been trading in this upward sloping channel since the middle of November of last year. So that is suggesting to me there is a little bit of optimism in the markets right now. And personally, I am cautiously optimistic about the short-term movements in the Australian markets. In the long term, I'm much less cautiously optimistic. In fact, I'm a little bit pessimistic. But just because I'm pessimistic in the long term doesn't mean I can't take advantage of the short-term movements in the short term. So over the past 2 weeks, the XJO has risen 2.5%. And it's been a very healthy move up because we had been trading at the bottom of that channel for about a month. And if we fell below that channel, that would be a fairly bearish move. So the two things I'm looking for here are either breakouts to the upside or above the channel, or a break below the channel, and they would signify two completely different things. If we get a breakout to the top of the channel, that could be suggesting we're going to go through a short-term bull run like we saw in late October, November of last year. You can see that little bit of a bull run we saw there, where the XJO went from about 5,900 to 6,700. Or if we move towards the bottom and fall through the bottom of this channel, that will be a bearish move, and potentially my sort of pessimism about the long-term future of the markets could be coming to fruition. But until we see that, I'm going to play the markets accordingly, and my investing strategies won't change. I made no acquisitions last week, week before Easter, but this week I did make 2 acquisitions, Zuno and CleanSpace. I made these acquisitions for different reasons. Zuno released a very positive announcement to the market. I did a video on that announcement. Share price rose 50%. Now, the market was becoming really negative with Zuno, and I think it was really overreacting to the fact that we're coming out of COVID-19 and people won't be using Zuno products anymore. That was a complete fallacy and misread by the markets. And when they released that announcement, I think the market realized, whoops, we made a mistake. And that's why the share price rose 50%. And the subsequent days after they released this announcement, and you can see what happened with the share price. I'll show you the graph soon, or the chart, and that's when I bought in. It was quite positive movements in subsequent days. Now, CleanSpace was the complete opposite. They released quite a negative announcement to the market, and the share price went down a significant amount. And I think, again, the market is overreacting, thinking that CleanSpace, the only reason they were being successful was because of COVID-19. But this was a growing company before the pandemic. And no doubt, I think, once we get out of the COVID-19 vaccines and everything goes back to normal, CleanSpace will return to growing at a real good rate. So again, I think the market's overreacting, and I saw that, and I went at these prices. It's a fairly good buy now. And the other thing why I bought into CleanSpace was the market reaction has become a little bit more bullish in the very short term, and I'll show you the graph in a second or so. So during the week, I did make a partial disposal of my holdings in Stone Horse Energy. Share price went from 2.4 cents to 4.2 cents. So I decided, because it ran up fairly quickly in a very short period of time, I decided to sell out more than half of my holdings, actually less than half of my holdings, so 50,000 shares at 4.2 cents. And then the share price went down to 2.8 cents, which it is currently. Now, I do use ShareSite to track the performance of my portfolio versus the benchmark, which is the STW. And I did find a bit of a flaw in ShareSite, particularly when it comes to partial disposals. So it said, when I clicked on Stonehorse Energy, it mentioned my capital gains for the period, the 2-week period, was only $240. And what it looked at was my remaining holding, which was 60,000 shares, and the share price went up 0.4 cents, or 0.4 cents. So 60,000 shares by 0.4 is $240. So I was completely ignoring the fact that I sold out 50,000 shares when the share price rose from 2.4 to 4.2. So that's $850. It completely ignored that I made $850 on the shares I actually did sell out. So that is a bit of a flaw in ShareSite when it's tracking the performance of your portfolio. So I think that only applies to when you sell out a portion of your holding. So if you do use ShareSite, make sure you keep that in the back of your mind. There is a bit of flaw to the way they calculate your returns. Now I just want to compare the performance of Kneppy's portfolio to the benchmark, which is the STW or the XJO, and very happy to say that Kneppy's portfolio gained 6.4% for the fortnight. So extremely happy with the overall performance of the portfolio. But even though I'm extremely happy with the overall performance, I am a little bit unhappy with the performance of two companies within the portfolio. And those two companies are Treasury Wine and Blackmores. And those are the two of the four companies that have gone backwards during the time I bought them. So Treasury Wines is down 2% and Blackmores is down 5%. So I'm almost at the point of selling Treasury Wines. So I think all the positive sentiment that could have been coming into the market has now gone. I think one of the reasons behind that is because I think China said they're going to maintain tariffs on Australian wine moving forward. And Blackmores, no idea. I'll keep that holding there for a little bit. It's very liquidly traded and the share price can move quite a bit. So anyway, I get the best and worst performers of the portfolio from ShareSite. So in fact, the best performer for my portfolio was Stonehorse Energy. I've already mentioned that in the previous slide, and I'll actually talk about that in the next slide as well. But ShareSite says the best performers for the fortnight were TPC, EML Payments, and SG Fleet. EML Payments and SG Fleet both released some news to the market, and I'll talk about that news when I get to their slides. And the worst performing companies was Treasury Wines and Costa Group. I'm not concerned with Costa Group because they had gone on a bit of a bull run and it was time they went through a short-term correction. So let's hope it is a short-term correction. But my overall gains for Costa Group at the moment are about 30% or so. Now on to the best performer of the week, Stonehorse Energy. So I usually start with the acquisitions, but because I've already talked about Stonehorse, I'll start with the best performer, then I'll go to the acquisitions, then go through the remaining best performing companies, and then finish with the worst performing companies. So Stonehorse Energy. Now the whole reason I bought into Stonehorse Energy was all about volume. So I'm a massive fan of volume. I think it's one of the best indicators you can use to indicate the sentiment in a company. And when you start to see volume increasing, that's showing you that the market is becoming more and more interested in that company. In fact, if you go back to May 2020, Stonehorse was traded on 5 of 20 or 21 trading days during that month. No one cared about this company at all. They made a few deals and the market started getting interested, and you can see the peaks in volume during the last 5 months or so. And every single time we've seen an increase in share price, it's corresponded to an increase in volume. And that's actually quite bullish. And every time we've seen the share price drift back, we've actually seen very low volume. Again, that's bullish. Now that changed in the last 4 trading days. In fact, we've seen really high amount of selling during that period. So a spike in selling on these down days, and that's a concern to me. In fact, on balance volume has plummeted during that period. So that's one thing I'm going to keep an eye on during the next few days to see if that selling has continued or it's going to be exhausted or dried up. So one concern about Stonehorse Energy right now is that increase in volume in the last few days. Now on to the two acquisitions I made during the week, and CleanSpace was really not, or doesn't fall into the buy category or buy philosophy I have, but there are reasons I bought into CleanSpace. Now this is a company I've been following for quite a while, but I did think it was quite overvalued when the share price was between $6 and $7. There is an investing service I do, pay $99 a year for. They did recommend this company at $7, and I did not like that recommendation at all. And particularly when they released their half-yearly results towards the end of February, that was a definite sell signal. We can see the share price went down on pretty good volume, and without doubt, the market did not like the half-yearly results, and they were selling out. And that was the first sell signal. And then we saw subsequent days, the share price kept going down. So again, that should have been a real telltale sign to sell out of CleanSpace. And then they released a very negative report or announcement to the market, and the share price fell to $2 on massive volume. So what I've been waiting for CleanSpace, because at these levels, very good value compared to where they could be heading in the next 5 to 10 years. In fact, this is a company that wouldn't surprise me to see a valuation of more than $1 billion in 5 to 10 years. And right now, their valuation is about $150 million. So what I was looking for here is a value play, and I'm looking for some sort of exhaustion in the volume. And we actually did see that. We saw very low volume the last few trading days, and I think the sellers are becoming exhausted, and that's when you want to buy in, because at this point in time, there's no downward pressure in the share price. And what's happening in the last 5 or 6 trading days, the share price is going sideways, is very positive, particularly when you compare to what happened at that sell signal in the end of February with the half-year reports. The share price kept going down, so there's a lot of selling coming to the market. So fund managers were seeing some bad signs and we're selling, and right now we're not seeing fund managers sell out, and more than likely we might see some fund managers see value in CleanSpace and start buying, and that buying will push up the share price. Now on to Zuno, and this is a case where the market completely overreacted to the downside. In fact, I was been watching this share price decrease for a few months, and it just kept on dropping and dropping. And the further it dropped, the more excited I got. It got to about 60 cents, and I was seriously thinking about buying in. My main mistake here was being a little bit too patient, hoping the share price would drop a little bit further, because Zuno released an announcement to the market, which was very positive indeed, and the share price rose 50% in one day, a very bullish one-day candlestick on massive volume. So I think the market came to the realization they were wrong about Zuno, and we've seen actually positive share price action in subsequent days from the release of this announcement. In fact, the 3 red days we saw on Tuesday, Wednesday, and Thursday were on lowering volume, and then when we saw the share price rise in Zuno on the Friday, up 8%, we actually did see that on increasing volume. So very bullish price action when it comes to Zuno over the past 5 days, and that's the reason I bought in at 84 cents. My other 2 best performing companies both released news to the market during the past fortnight, so I did a bit of discussion on SG Fleet in update number 18. So if you want more of a detailed description of their acquisition, you can look at that video. But they announced the acquisition of LeasePlan on the 31st of March and finally went back into trading on the Tuesday of last week. So that would have been like the 4th or 5th of April. And the market loved this announcement just like I did. So I do believe the market was anticipating this, waiting for some sort of consolidation within this area, this space. So this is novated leases, that sort of thing. So you're talking about SG Fleet, Smart Group, Macmillan Shakespeare, Eclipse, and then a whole host of non-listed companies as well. So this acquisition of LeasePlan, I believe LeasePlan was the biggest player in this space. So now SG Fleet will be a big player. No coincidence, when they came out of trading, the share price opened above a level of resistance. And you see this quite a bit. In fact, you saw this with EML Payments as well, and the share price has stayed above that resistance level. So fairly bullish opening to SG Fleet's share price when they reopened. So all things said, this is something I was waiting for, and I'll keep holding SG Fleet for the time being. Now, hopefully there's going to be more consolidation with this in this space. And when that consolidation finishes, I think that's the time when you sell out of these companies. just like we saw in the telecommunication space, there was a flurry of acquisitions going back 6 or 7 years ago. As soon as those acquisitions stopped, a lot of those companies' share price who had been consolidated fell quite significantly over time. Now I'll talk about EML Payments, and the whole reason I bought into EML Payments was the release of the half-year results on the 17th of February. And the market loved it, and you can know the market loved it by the increase in share price on massive volume. And that's a very good sign to buy into a company on those sort of indicators. So that's my reason to buy into EML Payments. I did actually like the results as well. And then the share price went sideways for a while, consolidated, we'll say, and we did find or see a bit of resistance at just under $5.50, so around $5.40, and that's that horizontal blue line that I put there. And then on the 7th of April, EML Payments acquired Centennial Limited and enters the open banking market. So I haven't read that announcement just yet, but I don't need to because the market loved that announcement. And we can see again the share price rose on good volume, just like it did with the half-year results. And it's not a coincidence at all, just like we saw with SG Fleet, that the market reopened at the share price just above the resistance level and has stayed above that level. It's not a coincidence. Coincidences don't come in twos. I've just shown you 2 examples when a share price has just opened above a level of resistance. So just keep that in the back of your mind moving forward. I've seen this a lot. So I completely forgot about TPC Consolidated, and if you take away Stonehorse Energy, this was the best performing company of the week. So this is a slide from my previous update number 18, and TPC during that period was the worst performing company of the week. And I surmised that that drop in share price that led it to becoming the worst performing company had come to an end, which I mentioned with the capitulation question mark. We saw the exact same thing in October last year. We saw a rapid increase in the share price on the release of the full year results, and we saw a drift back in the share price. And when we saw a peak in the volume, or selling volume, that was capitulation, and that was the bottom of the share price. And then I just surmised that we might have seen a capitulation in the share price just after this massive rise in share price after the breakout with the release of the half-year results. So the share price got down to about $2.15, and I thought that could have been it. That could have been the low, and we might see a rise in the share price. Well, did we? Well, I've sort of given away that this is the second best performing company in my portfolio. So a little bit different with TPC Consolidated. So I want to show you a couple of snippets from the ComSec page. So on the right, I'm showing you the last 5 trading days in TPC. So TPC doesn't trade every single day. So the first day I've shown you here, right at the bottom there, is the 23rd of March, and this was the capitulation. This was the exhaustion of sellers who were willing to sell out of this company, and after they sold out, there was no one else willing to sell. And when I mean no one, I mean no one, and that's why the share price has just drifted up on very low volume, because no one wants to sell out of this company now. Everyone who wanted to sell out have been sold out. They've sold their portions of their holdings, and that's it. And when you've got no one willing to sell, the share price has to increase because you've got buyers willing to buy, but no sellers willing to meet those buyers. And you can see that in the buy and sell depth on the left here. In fact, I know the next time TPC trades, the share price will increase because the first bid there, the buy bid, is at $2.58, which is higher than the current share price, $2.49. So if anyone wants to buy into TPC, they have to raise their share price because there are no buyers. You can see that in the buy depth, the sell depth. The first sell bid is at $2.80, only 300 shares. And then after that, it's $2.95, 2,500 shares. So if you want to buy TPC, you have to drive up the share price because there's no buyers right now, no buyers at all. And one of the reasons there's a very lack of sellers is because the directors hold a massive portion of shares in this company. Now on to the 2 worst performing companies in my portfolio. One company I am very close to selling, that is Treasury Wine Estates. Right now it's at short-term support. That short-term support is $10.20. If it falls below that short-term support, that would be very bearish. So I'm hoping there's going to be a bit of a rebound in the share price. But the last time it got to support, there was the rebound in share price was really, really weak and pathetic. So not much hope with Treasury Wine states moving forward. And I think there's a lot of negative sentiment right now because I think, if I remember correctly, the Chinese government has maintained these tariffs on Australian wine for the foreseeable future. So until the Chinese government backs off on these tariffs, Treasury Wine could be under pressure with their share price unless they gain traction in other markets. And though there's a chance I might be selling out of Treasury Wine states, particularly if they fall through that short-term support, Costa Group is a completely different story. A nice looking chart here. In fact, a lot of good technical signals here. So we did see the breakout in the share price on the release of the full year results, even though we've seen the share price in a fairly medium-term uptrend from the release of the half-year results back in August 2020. On the release of their full year results on really good volume, the share price broke above that resistance line at $4.40 and has maintained the share price above that for ever since then. In fact, it did test $4.40 or the new support line in the middle of March and then bounced off it on good volume as well. And there's no reason for me to sell out. The only reason this was the worst performing company of the week was it did have a bit of a stellar run for a few weeks, about a month ago or so. And then we just saw the share price retreat on lowering volume, which is really good. That's what you want to see. Share price increasing on good volume, decreasing on low volume, and then starting to increase again on higher volume as well. So real good technical signals right here about the Costa Group moving forward. So that's all I've got on update number 19 to Kneppy's portfolio. I hope you've enjoyed this video. If you do have any questions at all, make sure you leave it in the comment section and eventually I'll answer every single comment. Well, I hope so anyway. Now, I'm not a financial advisor, so although I'm doing very well with my portfolio, I'm not an expert or a professional. I'm just an amateur. But sometimes amateurs can simply destroy the market, and hopefully I'm showing you that. So if you have any questions, leave in the comment section. Otherwise, I'm not a financial advisor, and if you do need financial advice, make sure you seek out a financial advisor who can speak to your own financial needs, and just keep in mind that financial advisors cost heaps of money. That's all for this video. See ya.